Hey, welcome back to the What the Wealthy Do podcast, where we break down the money moves the wealthy make and show you how to apply those same money moves to your own personal wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital, an investment firm that focuses on providing women and people of color access to an institutional quality portfolio of alternative investments. And so today we are going to talk about one of the most, I don't even know if it's underrated. I think it's just people don't really think about this stuff. But this tax move is so freaking clever. And we're going to talk about this tax move that is so underrated in wealth building. And it's basically Roth conversions. I mean, we talked about the backdoor Roth conversion already, but I want to dig a little deeper, especially when you think about the fact that this is the play that everyone notoriously talks about. Peter Thiel, who did this with his PayPal stock that's now worth $5 billion that's sitting in a Roth account. And I am thinking about this as I used my 401k to partially fund Margins Capital. And so I want to start converting some of it to a Roth so that it can grow tax-free instead of now I'm kind of worried like, whatever. So anyway, I was also motivated to write and talk about this because I have someone that's very dear to me who listens to my podcast. We're not going to shout him out, but he is sitting on millions of dollars in his 401k and he wants to retire soon. And he has to figure out, like, I mean, it's a good problem to have, obviously, but how do I avoid giving the IRS all of this money that I've been saving for my career? So this podcast episode is dedicated to him, and hopefully he finds this helpful. But we've already talked about it anyway. Obviously, I've already got him set up. But regardless, he inspired this podcast, so shout out to you. And before we get started, though, I want to remind you all, as I do every episode, that the content in this podcast is intended to be used for financial education and not financial advice. Take this information, do your own research, talk to people to help you to actually accomplish what we talk about in this episode, and give me feedback. So yes, let's get started. I'm so excited. Okay, let's start with the foundation. Every dollar in your retirement account is going to get taxed at some point. The question is, when do you want to pay the tax? So a traditional 401k or a traditional IRA is tax deferred. You contributed pre-tax dollars. Some of you might have been able to get a deduction the year you contributed if under certain circumstances. But for all intents and purposes, the money has been growing tax-free. But the IRS is going to want their cut at some point. Like, they're going to want it and they're expecting it. And so they're going to get it when you start to pull money out in retirement. Every dollar, your contributions and all the growth will get taxed as ordinary income once you start making distributions when you retire. A Roth 401k or a Roth IRA is the inverse of that. So you pay your tax up front, but once it's in there, it grows tax-free, and qualified withdrawals in retirement are tax-free forever, which is so nice, right? And so we talked about a Roth conversion. A Roth conversion is when you take money sitting in a traditional account, like a 401k or traditional IRA, and move it to a Roth account. And you pay ordinary income tax on the amount you convert in the year you convert it. In exchange, you never have to pay tax on that money again, ever. And so the whole game, the whole idea of this comes down to one question. Is your tax rate today lower than your tax rate will be when you retire? And if yes, you make the conversion. You pay the lower rate now and lock in tax-free growth. If no, you leave it alone. You'll pay the lower tax rate later, right? And that sounds very simple, but the reason most people get it wrong is they assume their tax rate will go down in retirement. And for wealthy households, that's often not true. And for the people that are listening, you investors, y'all gonna be worth more. Yeah, that's just not necessarily going to be your reality, even if it was your mother's or grandmother's or grandfather's or dad's reality. So here's the mindset shift. Most financial advice is written for the average American, someone who earns less in retirement than during their working years. For them, deferring taxes makes sense. But the wealthy and y'all are playing a different game. And here's why they convert. They convert because, one, they expect tax rates to rise, right? Federal tax rates are at historic lows. I know it don't seem like it, but they are. The national debt keeps climbing. Most wealth builders assume future tax rates go up, not down. Paying tax at 24% today beats paying 32% in 15 years. It's real, right? Reason 2, required minimum distributions start at age 73. The IRS forces you to pull money out of your traditional accounts every year, whether you need it or not, right? And those RMDs or WMDs, if you listen to my other retirement episode, get taxed as ordinary income. And for someone who's accumulated $3 or a $4 million 401k, those forced withdrawals can push them into top brackets in retirement. Roth accounts have no required minimum distributions during your lifetime. And so you control when the money comes out. Reason 3, estate planning. If you leave a traditional IRA to your kids, then they have to drain it within 10 years and pay tax on every dollar you left them. And that's a traditional IRA and or your 401k. So that means if your kids are in their peak earning years, that inheritance gets crushed because it is taxed as earned or ordinary income, right? So you're going to push your kids, if they're not already in the 37% top tax bracket, the 401k or the IRA that you left them will push them into that bracket, and they are going to have to pay taxes on the money that you left them. Ugh, right? However, a Roth IRA passes to them tax-free, and they get a decade of tax-free growth. And just to be clear, when I say decade of tax-free growth, eventually at the end of year 10, your kids will have to withdraw that money and put it in another account, but they at least don't have to pay taxes on it. They are going to have to interrupt the investments and move it over, but like I said, they got to move it over to whatever account that they want to, but at least they don't have to pay taxes on it. The fourth reason is the wealthy look for any year their income drops, right? So if they take in a sabbatical, if they suffered a business loss or early retirement before Social Security kicks in, they will fill up the lower brackets with conversions while the rate is cheaper, right? And so the last one, that's the real strategy. When your income is down and you are paying lower tax rates, then that's when you want to make that conversion. Let's talk about numbers. This is really a math equation. You can't run a Roth conversion strategy if you don't know where the bracket lines are. And so for 2026, the 7 federal tax rates are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And if you recall, the way our taxes work, there is a marginal tax rate. So say the first $10,000, you pay 10% taxes on it. As you know, you don't pay 10% or 20% or 37% on every dollar you earn, right? You pay up to $9,700, you pay a 10% tax. And then from $9,700 to around $39,000, you pay 12% tax. And then from $39,000 to around $84,000, you pay a 22% tax, and so on and so forth. So this information is online. Like, we're not going to spend a lot of time here. So just to be clear, let's just pretend we're talking to single filers. So the wealthy use those bracket lines like guardrails. The play is figure out where the top of a reasonable bracket sits, then convert just enough to fill that bracket without spilling over into the next one. So let's do a case study. Let's pretend we're going to talk about Maya. She's 58. She's married, filing jointly, recently retired. Her husband still works part-time. Their combined earned income this year is $120,000. They have $1.2 million in the traditional IRA from her old corporate career, right? So her 401k converted to a traditional IRA. If they do nothing, that $1.2 million grows for the next 15 years to maybe $2.5 million. And so required minimum distributions at 73, that's roughly around $95,000 a year of forced taxable income on top of the Social Security she earns and her husband's pension. And so they'd be sitting in around the 24 to 32% tax bracket every single year for the rest of their life. If you're at a place where you're like, okay, girl, I got all this information and I still don't know where to get started, you should look into joining me and some amazing women in the Sovereign Collective, where we are collectively working together to support each other on our own independent wealth journeys. You can look us up at joinsovereign.co, where we are holding each other accountable and supporting each other as we build the investment portfolios of our dreams. Let's now consider conversion. Their taxable income after the standard deduction is about $88,000, which is right at the top of the 12% bracket, right? The 22% bracket runs all the way up to $206,000. So they have roughly $118,000 of room inside that 22% bracket before they hit 24%. So this year, Maya converts $118,000 from her traditional IRA to a Roth IRA. And the tax bill on that conversion is around $26,000, a blended rate of about 22%. So she does this every year from age 58 to 72. And that's a 15-year conversion window. And over that time, she converts roughly $1.8 million at an average tax rate of 22%. So compare that to doing nothing. Right? If she doesn't do that, RMDs would hit at 24 to 32% plus state tax, plus pushing more of her Social Security into the taxable column, plus potentially triggering higher Medicare premiums. And so that's the trade-off that she has to decide. It's not about avoiding tax. It's about choosing your tax rate. It's about picking your poison. Like, do you want to pay some now, but ultimately lower than when you're older and it really matters, right? Because the older you are and you're on a fixed income, it hurts more. It certainly hurts more. So let's get specific about when to convert. The best time to convert is during a low income year, right? So if you're having a sabbatical, you're between jobs, you decided to do early retirement before Social Security, you have a year in your business that had a loss. These are gift years, like, because you get to fill up the lower brackets. I know it's hard to think about that because you're like, oh my God, I just had a loss. My money is funny. I'm freaking out. But this is when you need to like lean in, right? Because again, you're making less money. And so you have more space from a tax perspective to do the conversion. So number 2, early retirement. So if you decide to retire and it's before Social Security kicks in and before required minimum distributions kick in. So say like you retire at 62, but you don't claim Social Security until you're 70. You've got 8 years where your income will be artificially low. And that window is conversion gold. Number 3. If the market is down, right? If your IRA drops 20% in a bad market, convert now, right? Because you're going to pay tax on the depressed value and all the recovery growth happens tax-free inside of a Roth. This is one of the wealthy's favorite moves during corrections. Number 4, when you expect higher rates ahead. So current rates are scheduled to stay in place, but no one knows what Congress does in 5 years or 10 years. And if you believe rates will go up, then you convert at today's rate. But certainly, even if the rates don't go up, you do know that your investments will go up, right? So you are automatically going to be paying more later because the amount of your pie has gotten more valuable. That's kind of 4A. Now, number 5, the last thing you want to think about is estate planning. Like if you're thinking about how you're going to leave money and significant money to your heirs, and you want to leave it to them without hardship and without, just kicking the can down the line so that they will get less because taxes is going to eat it up. That's a reason for you to convert as well. What you don't want to do is if you have to pay the tax from the IRA itself, this is a huge mistake because say, for instance, you convert $100,000 and you pull $24,000 of that $100,000 to pay the tax. then you just permanently reduced the principal that you're converting, right? And so the math only works if you can pay the conversion tax from outside of the principal. Basically, you want to pay the tax from your outside money, not from the money that you're trying to convert. And you also don't want to convert in a peak earning year. So if you're a high earning professional and you're 40, sitting in the 32 or 35% bracket, this is the worst time to convert. You want to wait until your income drops, and you can plan for that, right? You also don't want to convert if you need the money in less than 5 years. So Roth conversions have their own 5-year clock. If you're under 59 and a half and pull converted money out before 5 years passes, you can owe a 10% penalty on it. So you want to convert money that you don't need to touch. Also, don't convert if it pushes you into IRMAA territory. So that is basically your Medicare premium surcharge. So if you're 63 or older, a big conversion can spike your Medicare Plan B and Plan D premiums 2 years later. And so you want to run the numbers carefully. Like, we're trying to avoid a spike in Medicare. And you also don't want to convert if you're planning to give a lot of it to charity in retirement, because that is one of the few tax plays that you will actually have. Qualified charitable distributions from traditional IRAs are extremely tax efficient. And if you're philanthropically inclined, leaving money in a traditional account may save you later. And before I tell you about the mechanics of how to actually do the conversion, I want to talk about the ROBS 401k. That's the rollover business 401k. So this section is for my entrepreneurs, right? If you funded your business using a rollover business startup 401k, I want you to lock in, right? Because this is for me and you. And this is one of the most overlooked tax moves that I see. And so with a ROBS 401k, you rolled your pre-tax funds into a 401k inside your new C Corp, so your business. And that 401k used that money to buy stock in your business. And so your retirement account literally owns shares of your company. This is literally what we did for at least my portion or my half of margins. And this is great, but here's what nobody talks about. Your business stock is sitting inside a traditional 401k. And so when you eventually exit or sell the business or do a stock buyback, all those gains come back to the traditional 401k and they get taxed as ordinary income when you start to pull that money out. Right? And so you could build a $5 million business, you sell it, and the proceeds go into your traditional 401k. And then over the years, you pull that money out, paying ordinary income taxes, ordinary tax rates, potentially 32% and 37% federal plus state. And that is a brutal tax bill. And so this is the play. You could do a Roth conversion here. And so where the pre-tax money is converted to Roth while still invested in your C corporation stock, this should happen prior to the buyback of stock, assuming the value of the stock will continue to increase. Now, if you don't convert it prior to the buyback, you lose the benefit of tax-free earnings on the appreciation, right? I mean, you get what I'm saying. What I'm saying is you convert the stock itself to a Roth 401k while the business is still worth relatively little. And then you pay tax based on the current fair market valuation. Then all the future growth, every dollar of appreciation between conversion and exit happens inside the Roth tax-free. Okay? All right, so let me put a number on this for you. Say you funded your ROBS with $200,000 3 years ago, and the current valuation puts the company at $400,000. You convert the stock to a Roth 401k today. You pay ordinary income tax on $400,000. Maybe that equals about $100,000 in federal and state taxes. So it's $100,000. Well, it's not a little bit of money, but 5 years later, you sell the business for $4 million. That is a $3.6 million of appreciation inside a Roth, right? So that is tax-free forever. Assuming you meet the qualified distribution rules, account open at least 5 years, and you're over 59 and a half, right? But without that conversion, you'd be looking at over $1 million in federal taxes alone when you eventually pull the money out. So the catch is you do need a defensible business valuation at the time of conversion. You need cash outside the retirement plan to pay the conversion tax. You need to do this before the value spikes, because once the company is worth $10 million, the conversion tax bill becomes unaffordable for most people. So if you're a Rob's owner, like me, and your business has real growth ahead of it, like me, this is a conversation to have with your CPA or your plan administrator like soon. And so this is real, right? I am literally thinking about this and I'm trying to identify the sweet spot from when I have the extra money, because I don't have it yet, when I have the extra money to pay the tax bill, and how to make sure to get a proper valuation for margins so that I can pay the tax bill. All right, so let's talk about mechanics. So for a traditional IRA to a Roth IRA conversion, I mean, you're going to contact your brokerage account, Fidelity, Schwab, Vanguard, or any custodian of your traditional account. And they will move the dollars from one account to the other, and they will issue you a 1099-R at the year end. You report that converted amount as income on your tax return and file it along with however you file your taxes every year. For a traditional 401k to a Roth 401k, your employer's plan has to allow in-plan Roth conversions. Most modern plans do. And so you have to log in your portal, you request a conversion, you might have to get on the phone with them, but they will do it. Right? So that's the great thing. For a Rob's 401k to a Roth 401k with company stock, this is a little bit more complex. You do need a current business valuation. Your plan documents have to permit in-plan Roth rollovers. And you usually work with your Rob's provider or third-party administrator to execute it properly. This is something you do not want to do this yourself. But okay, 2 additional rules that I want to highlight. One is the pro rata rule. If you have pre-tax money in a traditional IRA and you're doing what's called a backdoor Roth, the IRS makes you blend the basis across your IRAs. This trips people up. Make sure you talk to your CPA if you have an existing IRA. And the second is the conversion tax. You need to be able to pay the conversion tax without side money. I said it before, I will say it again. I'll keep saying it. Never use your IRA dollars to pay the conversion tax. The point is you want to keep this money working for you as long as possible, and you don't want to cut your compound interest off at the knees. Okay, so this is how we're thinking about this at Margins, and by we, I mean me. You want to build a multi-year conversion plan. You don't want to just make one big conversion, giant lump sum, and get crushed at 32%. You want to map out a 5 to 10 year ladder, and you want to identify your conversion window. Like that's the years between when your income drops and when required minimum distributions start at 73. For most people, that's the early retirement years. You want to fill your brackets strategically. You want to convert exactly enough each year to fill the 22% to 24% bracket, but stop before you hit the 32% tax bracket. And for business owners, you want to convert early. You just do. I know it's hard because we're thinking about our money and we are making corporate minimum wage is what I call it. But if you got a Rob's and an S Corp or any retirement account holding a business entity, the time to convert is when the valuation is low. So find the money, find it. Because you will be happy that you did this. You don't think Peter Thiel's sitting pretty and just get giddy every time you think about his $5 billion that's growing. I mean, it was $5 billion a couple of years ago. I am certain it is worth more than $5 billion now. That is tax-free. And then you want to pay your tax with outside money, like always. We talked about that. Lastly, you want to coordinate this with everything else. You want to think about how is this going to impact my Medicare, my Social Security timing, my capital gains, or charitable giving. This is a quarterback decision, not a solo one. So you want to get the people that knows what's going on, a CPA, a financial advisor if you have one. You want to get all your people, your estate lawyer, all the people on the same page, right? This is not something that you don't want the left hand to know what the right hand is doing. All right, y'all. So I am in love with this conversation. This is next level private wealth management conversations. This is conversation we're supposed to have. Ain't nobody trying to get to 65 and be like, what? Ain't nobody told me nothing. That is not going to be the case for us. We're going to know what is going on. We are not outsourcing these type of decisions and strategies to other people. Don't nobody care about your money like you do. You care about your money. So this is stuff that we're talking about and we are going to be prepared for and we're planning ahead for. So if this episode opened your eyes to a strategy you had not considered before, Please share it with a friend. Follow the show. Drop us a 5-star review. Like, I really just love this conversation. I love this conversation. I love that I'm thinking about this and that I'm in a position where I need to be thinking about this, and you are too. So anyway, if you are in a place where, okay, you're like, girl, I got this information, but I need some help, and I am trying to make myself the quarterback that I need to be for my own private wealth situation, consider joining the Sovereign Collective, because we are having these conversations all the time. You can find more information at joinsovereign.co, and we hope to see you in the room. But until next time, bye.